Hello, Mike Swanson of Wall Street Window here with you today. And I want to talk with you about 5 stocks that I think are going to get into some trouble in the first quarter of 2017. We're entering this new year. We had a nice rally last year from February to really Christmas. And it really accelerated after Trump won the election in the Dow in particular, which went up towards 20,000. But there's some stocks that are kind of really dicey right now that are widely owned that I think are going to run into trouble for people that own them. And these are popular stocks. The number one stock I'm going to show you is Facebook. You might be thinking, how can I say that about Facebook? Well, look at this chart. And let me explain why. Typically, when you see a stock that starts to lag the market averages over a couple months, that stock becomes vulnerable to having a sharp pullback. And if the market pulls back at all, those type of stocks can lead to the downside. So even though Facebook was such a popular stock to own in 2014, 2015, it's still one of the most popular stocks to own. Because it led the market during those years, it's now becoming a laggard. Look at this chart. The 2 lines below show you something very interesting. The red line is the price of Facebook divided by the S&P 500. It's a relative strength ratio. When that ratio goes down, it means Facebook is lagging the S&P 500. Facebook has been doing that since the end of October, a danger sign. The second line is a white line on balance volume indicator. It's a running total created by adding the up volume. When there's a day the market's up, it adds the volume. But when there's a day in which the stock is down, it subtracts the volume on that day. So when this indicator is going down, it means overall, there's more selling volume than up volume. It's a sign of distribution. It's a warning sign, and Facebook's doing that. Facebook now has support around 114, the low of December and basically November, and we're right above it. If it breaks that support line, I think Facebook's going to correct. It doesn't mean Facebook is necessarily going to crash, go to $50 or something, but it means over the next couple of months, this is a weak stock, and it's going to likely correct and continue to climb. The next stock I want to tell you about, which is widely owned, is Google. Oh my gosh, Google also has been lagging the market since October. Now it's got support at 750. However, the unbalanced volume has disintegrated with Google sharply since October 2. The next stock I want to tell you about is Biogen. Biogen is a stock that simply has failed to rally for 2 years to match the performance of the market averages. It's the story of most biotech stocks in general. So as you know, the Dow's gone up to 20,000. The market averages did okay last year. Biogen is not been able to go close to the highs of 2015. It's a long-term trouble sign. On-bounce volume has been disintegrating also over the past 6 weeks. This is a stock vulnerable to experiencing a sharp pullback in the first quarter 2017. The next stock I want to tell you about is Amazon. Oh my gosh, Amazon's relative strength has been sharply dropping since mid-October, and on-bounce volume has been disintegrating. It's got support at its December low of 736. I think it's going to break that probably in January and take a tumble. Now, there's something common of all these stocks, which is important to notice. All of them are in the Nasdaq 100. The Nasdaq 100 has lagged the S&P 500 and lagged the Dow since the election of Donald Trump because there's been a money shift going into sectors that are poised to benefit from Trump's programs. That money's been going out of the fad stocks that have been so popular in the past that are highly valued. These are the stocks in the Nasdaq 100. That makes the Nasdaq 100 as a whole vulnerable over the next couple weeks and next couple months for if this money shift continues, and I think it will. And to show you another reason why the Nasdaq 100 is vulnerable, the top gaining stock last year in the Nasdaq 100 was NVIDIA. And it's now actually becoming the fad favorite. If you could think back to December 2015, I remember watching CNBC and hearing people on there say, the only 5 stocks you need to own are Facebook, Amazon, Netflix, and Google, the so-called FANG stocks. And because of what I just showed you in the performance of several of the stocks in the FANG complex, that storyline is kind of being forgotten or not talked about anymore. It's being replaced by a new storyline that says, the only stock you need to own is NVIDIA. Why are they saying that? Because NVIDIA beat the performance of those other stocks and was the top gaining stock in the Nasdaq 100. These guys on CNBC are pure momentum chasers. They tend to only talk about what's going up the most. And since those stocks are no longer doing that, they've simply forgotten about them. And they're replacing that talk with NVIDIA. Now, I'm not saying NVIDIA is going to crash or it's doomed, but I do think NVIDIA is going to pull back. And that's a bad sign for the Nasdaq 100 because it's the leader, right? And why do I think NVIDIA is going to pull back or at least pause, and that's enough to cause trouble? Well, yes, NVIDIA has gone up tremendously over the past 12 months, but at the end of the year, it had what we can call a key reversal day on December the 28th, on a Wednesday. What happened on that day was NVIDIA, the day before, had a big spike, went up about 5% to a new 52-week high. But on that Wednesday, it took back all those gains on high volume. It was actually a record down volume day for NVIDIA. And that signals to me that the best case scenario, and we'll just consider that, is that NVIDIA is going to now consolidate and go sideways. We've seen many such periods of consolidation that occur in 2016. Look what happened in August. Look what happened in October. Look what happened in June. Periods in which NVIDIA went sideways for like 3 to 4 weeks and digested gains. So the best case scenario is that's what's going to happen. So that means that over the next couple days, or let's say week or two, there's not that the odds of NVIDIA making a new high and having another surge and going crazy like we've seen it do several times in 2016 are very limited, very small. That means there's just not that much upside potential in NVIDIA. NVIDIA is the top leader in the Nasdaq 100. That means the Nasdaq 100 has very little upside potential. And with what you see in Facebook, Google, Amazon, Biogen, which actually those charts reflect what's going on throughout the entire NASDAQ 100 basically, that puts the odds of a pullback coming. That doesn't mean the stock market's going to crash, but pullbacks happen. They just happen. They're part of the way the market trades. If you look at the S&P 500, it fell to its 150 and 200-day moving averages, or through them, 3 times in 2016. These are the 2 lines right here on the chart. Right now, that's around the 2133 to 2150 area. Such a pullback is not, it's just a normal thing. Markets don't go straight up every single day. Even in bull markets, you get pullbacks and so forth. So I think that's what we're headed for, and that's why I've taken money off the table myself to buy later on a dip, and dips provide opportunities to buy into stocks and sectors that are going to provide new leadership going forward. So you get out, because things change, right? If you think about biotech, which I talked about, biotech was a leading sector in 2014 and 2015, and now it's a lagging sector. So the thing to done in biotech would have been to exit it completely, either in the summer of 2015 or at least by the end of 2015, exit it completely and move that money elsewhere. And I think that's going to be the story now for a lot of other fad stocks. Apple was a stock too, which was so hot in the past, but the thing that would have done would be exit Apple in the summer 2015 when the earnings problem started, or in the fall of 2015, and it's been lagging ever since. Apple's a stock to get out now too, I also believe, to use that money in better situations. So we've had a nice rally as I'm doing this video that I think has kind of petered out in terms of momentum. It's going to at least pause and most likely correct. So it's time to take money off the table and get ready to do some buys. in the first half or sometime in the first quarter of 2017, and that will set the stage up, I think, for us. It's what I'm doing to do well in 2017 and put us in the best position to outperform the market averages. I got more to talk with you. Stay tuned. I've got another video coming up going into more detail about the market situation, how to take advantage of all this, and do a lot. So, be talking with you soon.